Why Indian FMCG companies are growing more due to price hikes than actual volume growth? What if I told you that your company's double-digit revenue growth may actually be hiding a dangerous reality? Sales are growing, turnover is increasing, investors look happy, but consumers are not buying significantly more products. In fact, much of today's growth in the Indian FMCG industry is coming from higher prices, not higher consumption. And if you're a CEO, sales head, category manager, supply chain leader, or finance professional, ignoring this shift could lead to poor forecasting, wrong expansion decisions, and unexpected margin pressure. In this video, we'll uncover what is really driving FMCG growth in India, examine recent industry examples, and discuss what leaders must do before this trend impacts their business. By the end of this video, you'll understand why FMCG revenue is rising while consumption growth is slowing, the economic forces driving this trend, real examples from leading FMCG companies, the risks hidden behind value growth, and the 5 strategic actions every FMCG leader should take immediately. Let's begin. The illusion of growth. Let's start with one important distinction. There are 2 kinds of growth. Value growth means your revenue has increased. Volume growth means you have actually sold more units. Today, many companies are celebrating value growth, but volume growth is becoming increasingly difficult. According to CRISIL ratings, organized FMCG companies are expected to deliver 8 to 10% revenue growth in FY27. Sounds impressive, but here's the catch. Around 6 to 7 percentage points of that growth are expected to come purely from price increases, while volume growth is projected to slow to just 2 to 3%, down from 5 to 6% in the previous year. Think about that. Revenue is increasing, but consumers are not putting many more products into their shopping baskets. Why is this happening? There are 4 major reasons. Number 1, rising input costs, packaging materials, plastic, crude-linked derivatives, transportation, fuel. Almost every major cost component has become more expensive. Companies simply cannot absorb all these increases, so they pass a part of the increase to consumers through higher retail prices. CRISIL notes that crude-linked packaging costs are a major contributor to this pricing pressure. Number 2, inflation is reducing purchasing power. Consumers are spending more on fuel, more on electricity, more on essentials. That leaves less disposable income for discretionary purchases. India's retail inflation moved above the Reserve Bank of India's 4% comfort threshold in June 2026, driven by food and fuel costs. Consumers still buy toothpaste, soap, tea, biscuits, but they often buy smaller quantities, postpone stocking up, or switch to cheaper alternatives. Number 3, premiumization has limits. For years, FMCG companies relied on premium products to increase average selling prices. Premium shampoos, health foods, organic products, specialty, personal care. This strategy still works, but only for a segment of consumers. The mass market is becoming increasingly price sensitive. As a result, companies must balance pricing carefully to avoid losing volume. Number 4, rural demand is softening. Rural India has been a major growth engine over the last few years, but concerns around monsoon performance and inflation are creating uncertainty. CRISIL expects rural demand to moderate compared with previous years, adding further pressure on volume growth. Let's look at what leading FMCG companies are saying. Dabur recently indicated that price increases helped offset inflation, protecting profitability despite rising packaging costs. The company also acknowledged that it had taken calibrated pricing actions while managing consumer demand carefully. Godrej Consumer Products reported elevated raw material costs but responded with calibrated pricing, cost-saving initiatives, and media optimization. Notice the language. Not aggressive expansion, not explosive volume growth. Instead, pricing discipline, cost efficiency, margin protection. Let's understand industry-wide trend. CRISIL Intelligence estimates that FMCG companies recorded 6 to 7% revenue growth in the latest quarter, supported largely by selective price increases, while higher packaging, logistics, and food costs continued to pressure profitability. This is not a one-company story. This is becoming an industry-wide pattern. Why leaders should be concerned? Here's where many organizations make a strategic mistake. They see revenue increasing and they assume demand is healthy. But if your growth is coming mainly from pricing, Eventually, consumers react. They reduce basket sizes, delay purchases, trade down to economy brands, move to private labels, or simply buy less. That's when market share begins to erode quietly. Revenue may continue growing for a few quarters, but long term volume weakness eventually affects manufacturing, utilization, distribution efficiency, forecasting accuracy, and investor confidence. Revenue is a lagging indicator. Volume tells you the real health of your brand. 5 strategic actions for FMCG leaders. So, what should leadership teams do? First, track value growth and volume growth separately. Never celebrate revenue without understanding units sold. Second, focus on productivity before pricing. Reduce waste, improve supply chain efficiency, optimize packaging. Third, invest in demand forecasting. Today's consumer behaves very differently from 3 years ago. Fourth, build differentiated value rather than competing only on price. Innovation wins, blind price increases don't. Finally, monitor consumer behavior at SKU level. The real answers are hidden in category-wise and pack size-wise data. Let's recap. The Indian FMCG industry is still growing, but much of today's growth is being fueled by price increases rather than higher consumption. Input cost inflation, higher packaging expenses, fuel costs, and cautious consumer spending. These factors are reshaping the industry's growth story. For leaders, this means one thing: don't confuse higher revenue with stronger demand. Because in today's market, volume is reality, price is temporary. If you found this analysis valuable, subscribe to the channel for more data-backed insights on FMCG, retail strategy, category management, and business transformation. Until next time, keep questioning the numbers behind the numbers.